Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today, I wanted to address a question. That is, why do some traders prefer vertical spreads over just buying long calls? We're going to be weighing the pros and cons of a vertical spread versus a long call. Make a case for vertical spreads. Why do some have that preference? But then flip the script and make that case for a long call. We're ultimately going to place an example trade, but a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody. It's already chatting in out there in YouTube. Hello there, Mighty Mouse and Josh and David, Chuck, Ted, Gabriella, Roger, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series that kicks off promptly 11 Eastern every Thursday. We'd love to have you here in the live stream audience. And to help me out, I have my very good friend, Scott Thompson, is going to be hanging out in the chats with us. Scott's going to be addressing any questions that I can't get to just during the flow of the presentation. Scott and I go way, way back. We've been working together for more than 20 years now. So thanks for having my back there, Scott. I also want to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there. And you can find me on X at Cameron May CS. It's the best place to connect with me in between the live streams. I'm only on camera for about 4 or 5 hours a week. The rest of the time, best place to connect with me is on X. So at Cameron May CS. But let's get into this discussion. Why some traders prefer vertical spreads versus buying calls. But as we do, of course, we need to consider the risks associated with trading. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for what we're going to be covering today. First thing that we're going to do is have a look at our current example trades. I think there's at least one that probably needs some attention today. We're coming up on expiration tomorrow, something that a trader might want to avoid. It could happen tomorrow if we don't give some attention to that one position in particular. So we'll go through all of them. Then we'll look at the markets to see what's happening. Spoiler alert, markets are trading right near all-time highs, especially S&P 500. But then we're going to plan in place a new example vertical spread trade. We're going to be doing it on a long call vertical and comparing it to just buying a long call. Why do some traders choose that long call vertical strategy versus just entering into a long call? What are the potential advantages and the risks? We'll make little lists to compare each, and then we'll go ahead and place the example trade. So let's go right to the Thinkorswim desktop trading software platform. If you're not familiar with the platform that I'm using, this can be downloaded free of charge from your Schwab online account. Just go to the trade tab up at the top and look for the keyword Thinkorswim. You can download it right there, log in using your Schwab credentials, and you'll find yourself on a platform that looks very much like this with, maybe a little bit of, maybe some appearance differences, that sort of a thing. But the first thing I wanted to cover is actually a position that's no longer in our current positions because a couple of days ago, it hit its target and closed out. And that was Amazon, our Amazon trade. If we want to see that, let's go to our account statement. Let's type in Amazon here so we can see its history. So we opened a long call vertical spread for a 245 debit, and we had an order in to get us out if we could sell that for a 375 credit. That was executed on the 15th. So today's the 17th. So this is looking back on Tuesday. So if we go to our charts, we initiated that position right here, and it pretty much started to cooperate pretty well right from the start. But as it started to move upward, that hit our target exit, and we sold at that target, $125 per contract on 10 contracts, gave us that $12.50 profit. It's actually peeled back from that somewhat, so we probably would have seen those unrealized gains contract, and that's one of the risks of staying with an existing position that's already profitable. However, it's still, right now, price is still above the original spread, So it's still in position if it's able to make it to the expiration out here toward the end of July. I think this was an August 1st expiration. In any case, we still might be leaving some money on the table. There are pros and cons to exiting like this, but we're done. So that one's done. Let's move on to our next trade, which is our Apple position. This was last week's trade. We just took a small position. Just one contract as an example, did a long call vertical spread. And that is just sort of hovering around where we kicked things off. We're down $32 at the moment. So if you want to see that visually, maybe we'll zoom in here so we can see a little bit more clearly. We bought the 205 call down here, sold the 210 call up here. Our preference is to be above 210 as we move toward this July 25th expiration. That keeps us clear of this earnings announcement for those traders who prefer not to trade these sorts of positions over an earnings. So we're where we'd like to be, but you can see there's a pretty thin margin. We'd really prefer for this trade to go, let's get higher. That's what we'd like to see here, where the trader could be more comfortable. For right now, we're going to leave that one alone. Next up, we have GILD. And with GILD, we have a very long term, this is the 17th of June of 2027, long call. And we've been diagonalizing this. Bought the long call, selling shorter term calls against that. And the one that we're in right now, we sold it for 80 cents. It's only worth 8 cents. So a trader could here decide to close that out. That's 90% of its potential maximum gain on that short contract. Let's have a look at that. So there's our 115 short. You can see how we went right up there, teased against that. We initiated that position here. So we were down there. We've run up, just touched it. What was the high there? 114.87. We came within 13 cents of that contract going in the money. It doesn't mean that it's instantly exercised or assigned. It could even be assigned while it's out of the money, but it's pulled back again. So this net advance has been good for the long position, and this retracement has been good for that short position. So overall, doing well. So we're now looking at a contract that's just about to expire in 1 day. Now it's about 10 or 11 cents. Here's what the trader could decide to do here. We could close this out, assuming that we can get a fill, and be done with the trade, maybe sell one further out. Earnings are coming up, so we might want to keep an eye on that. Or with this so far away from the strike, because we just have to get one more day. Trader might decide to just hold on, and that one extra day can actually potentially add a significant percentage return to this trade. Pros and cons. This one, I'm going to let it go. I know that there are certainly some traders out there that might have a preference to just exit, but that one more day, increasing the returns here, having the potential to increase returns fairly significantly on a percentage basis, I'm going to let it go, but there is a risk in doing this. Obviously, this thing could go in the money. In a real account, it's the paper money account, there could be assignment, even if we're still out of the money. That just never happens in paper, so we kind of have a luxury here. So I'm just going to let that one go. Next up, we have NVIDIA, and this has something that should essentially be screaming at the trader here. It's a little tiny something on our monitor tab that should be pulsing. Cameron, pay attention to this. What is it? What do you see on the screen here that a trader might want to stay aware of? This little tiny acronym right here that says ITM. That means this contract has gone in the money. There's our short contract in the money. Someone has the right to buy shares from us for $170. Those shares are now worth more than $170, and that increases the probability of early assignment. I will say it doesn't mean that we're immediately going to get assigned. As a matter of fact, probably not, but still, that potential is there. And it's not there in paper. It's not going to happen. But yeah, this thing expires tomorrow. And if a contract, the closer we get to expiration and the deeper in the money that goes, that can elevate the risk of early assignment. And I think we need to do something with this one today. because if we leave it alone, there's a possibility. Let's look at this on a chart. There's the 170 strike we sold. Could this just start selling off today and maybe continue tomorrow, and before tomorrow's close, we wind up below the 170 strike and that contract expires worthless? That's a possibility. But assignment risk is real, especially in real life. And let's treat this like real life. If the trader is looking to avoid assignment, maybe they might choose to exit this contract. This is not going to be done at a profit. We sold that contract for $1. When did we sell that? That was down here. It was so far out of the money. Look at that. It was $10 out of the money. It's not anymore. That's now in the money. So we're going to be taking some lumps on this short call. However, that nice run up has been beneficial to the long call. So long call is actually doing fine. We're going to be realizing maybe about a $2.50 loss on our short call. Let's also look maybe further out in time. It's quite possible that this stock may have overextended itself, at least in the short term, could pull back. Wonder what we could sell maybe the 180 for if we went out here to August 15th. There's not an earnings announcement between now and August 15th. Not every trader avoids earnings. I don't want to throw that out like it should always be avoided, but just putting ourselves in the role or the shoes of a trader who prefers not to limit upside during an earnings announcement. Let's go have a look at the trade tab. Let's look at the 15th of August, and if we go up to 180, looks like we might be able to sell that for 390, 395. It's going to cost us about 350. There's a small credit here that can potentially be accomplished. The existence of credit or the lack thereof is not inherently good or bad. All that we're doing is we're saying, hey, we're going to take the losses on one of our short calls. Then we're going to get into another, and we'll see how that goes. For better or for worse, it carries its own potential advantages and risks. So I think that's what we're going to do. Let's see if we can roll that out to the 180 strike for the 15th of August. Let's go to our monitor tab, right-click on our short call, create a closing order. I'll create a rolling order, and let's sell. It'll say a calendar. That just means that we're in one order ticket, buying a call and selling a call. Yep, that's what this is. Buying the 170 to close it, but then we're going to sell the 180 to open for the 15th of August. That may be accomplished at a credit. Let's say that we're willing to settle for even a 40-cent credit here. Let's click confirm and send. Going to sell that diagonal, essentially buying back the 18th of July, rolling that out to the 15th of August, 180, 170. There are commissions to be paid on both sides of this, so $1.30 is going to reduce that net credit. And let's see if we can get that $40. I don't know if we can. You never know until we try. Let's let that continue to work up here in our working orders. Oh, it looks like we're right at the mark. Okay, sold it for 40 cents. Okay, done with that. So what we've done here, we've concluded that trade, but sold a new one up here. Let's draw that in on our chart. Carry that out here to the August 15th expiration, because that creates a new preference here. We're no longer concerned about this level. That one is a realized loss. It's chipped into our unrealized gain on our long, but we've provided some more wiggle room to the upside. All right, so we'll see how that new position goes. Done with NVIDIA, and then we just have our UNH position, and this one has just been a nightmare for the trader. When we kicked off this trade, look at that, it's down $9,000. It's not quite as bad as that, but still not a great trade. What we've done with UNH, we just own a long call on it right now, but we started this back on the 1st of January, way back here. Not the 1st, pardon me, the 9th of January. That was the initiation of the trade. But we had a premise for that trade. Let's see what might happen if we take a trade and we put ourselves in the shoes of a trader who says, I'm just going to ride this thing for the whole year. I'm just going to stick with it. I love this trade. No matter what happens, I'm going to make it work. Sometimes we can't. It just doesn't work that way. And that's what's happened with this. This is great example of what can happen when a trade just goes south on us. So we started things off as a diagonal spread. And along the way, let me spread this out a little bit. We've been able to take some profits on some short calls, but our long call has just been getting hammered in that diagonal spread. So overall, we've realized actual profits of, I think it's, you add these up, 860, 672, 370, 6, is that 6? That's 530, and 312. Total that all up, there's $27.45 of realized gain on short contracts that we've sold. But then we set that against about $9,100 of unrealized losses. It's not a good trade. This can be a great lesson for a trader who maybe has that tendency to just stick with the trade, regardless of whatever they see as their evidence to do otherwise. Were there times along this journey where maybe the trader might have wanted to just say, maybe I was wrong about this. Maybe I was wrong about this. Could have been. So what are we left with? Well, we have a long call. It's way up here, going to expire worthless, almost certainly. Well, we're not going to go all the way beyond the end of the year. I should just say it's very likely to just have decaying value for the rest of the year. We're going to stick it out, see what happens. But there is an earnings announcement that can get things potentially started to turn around. We're kind of stuck in a rut right now. We could sell a short-term call at the moment. A couple of potential issues with that. We might want to be aware that there's an earnings announcement in 2 weeks. Also, if we sell a call, selling one that's higher than the one that we own at higher strike, we might have to go way out in time in order to do that. That's a possibility. Or we're going to come way down and actually sell at a lower strike. That would be actually creating a reverse diagonal spread. Anyway, but for now, my plan is going to be no short call before this earnings announcement. We're going to let this ride through and then get back to it. Let's see. Probability trade is asking about why is this misbehaving compared to the rest of the sectors being up. You want me to do an economic analysis? I'm not going to go too far down that path. Sometimes I do in other webcasts, not in this one. I think it would just take a little too much time. There's a lot that I want to cover in the remaining 28 minutes. So my apologies. I'm going to park that question. It's a legitimate question, but I'm going to go back to our premise here, and let's set up a trade based on what we're seeing on the S&P 100 first. What's going on with the S&P? There's been a little consolidation here. I don't even need that drawing right now. Let's just clear that off so we can get a good, clear view of what's been happening with stocks. Right now, if we were to close where we are, I believe that would be the highest close of all time. Now, we're still early in trading. That could definitely change. But we're at 62.86. What was our previous highest close ever? 62.79. Yeah. So let's just say that our trader is trying to decide whether to do something bullish or something bearish. If our menu of choices is long verticals and diagonals, which is what we're limited to in this webcast series, some are bullish and some are bearish. And let's say that our trader is trying to plan something maybe out here, maybe for the next 5 or 6 weeks out through the 15th of August again. For some who would describe themselves as trend first traders, they may look at, what's been the trend of stocks recently? And maybe we'll just trade in that direction. It's not a guarantee of success. Stocks could turn. But let's just say that our trader thinks it's more likely to go up, that the S&P is more likely to go up than down from here. All right. So we're going to be doing a bullish example today. Let's remove that drawing. And the example stock that we're going to be using actually should be familiar if you've been following this webcast series for a while. We're going to be using Broadcom. We did a successful trade on this recently, and we're going to be going back to essentially that well. But as we do, what might a technical trader see happening recently? Well, since we broke through these highs from midwinter, broke up and through that, we got a nice support bounce there. And we've been making higher highs and higher lows since, and actually strengthening even into the present day. Again, a stock can turn on a dime, but let's say that our trader thinks, hey, this is looking pretty good for at least through August. Maybe they think stock is likely to go higher. And so now they're going to be choosing between some bullish strategies. Well, they might just buy a call, but other traders have a preference for buying a call spread versus a call. This is not going to be me making an argument that a call spread is superior to a call, because there can certainly be scenarios, one of which should be extremely apparent just from this chart right now. I'll revisit that concept. There can definitely be scenarios where a long call can produce much greater profits than a long call spread. But let's make the case here. Let's talk about why some traders prefer long call vertical spreads versus a long call. So I'm going to start off with what I'm going to call the pros. Now, specifically, these are pros of long vertical spreads versus long calls. All right, so another way that I might have labeled this, and I just got lazy and typed 4 letters rather than a few words, this might be the case for long vertical spreads versus long calls. All right, but we're just going to call it pros. One of those is lower cost of this strategy. So as we do this, let's map out an example trade. I'm going to come all the way down here. Let's roll on down. Our example trade is going to be a long call spread. Now, with AVGO, if we're bullish on this stock, we could just go buy a long call. So if we go to our trade tab, let's start off our discussion by saying maybe our trader is considering buying an in-the-money call. Bear with me. Let me reposition this just a little bit so I can get a little bit more space over here. There we go. Josh says, if we're bullish, could we or should we? Should we is a loaded term here, Josh, because should means yes or no. And I don't typically provide yes or no because that's advice, and I don't provide advice in these webcasts. I do educate. So could a trader consider legging into the spread? That means typically taking a portion of the spread at one point, waiting for a later date, and then doing the other part of the spread. Could do, yeah. Like especially, for example, if the trader has the conviction that the stock is likely to run up sharply, well, maybe they just buy the call, and if they are correct, that may build in some initial unrealized gains. And then if the trader starts to feel like things are getting top heavy, starting to maybe turning around, sell the short call at that point and create the vertical spread. That's a possibility. Yep. There are pros and cons to that. Obviously, the trader might be wrong, and then they're just exposed to the risk of owning a long call. But in any case, let's get back to our long call spread. But it does start with, conceptually, long call ownership. And I think for today's example, what are we looking at here? How about we just look at the 270 call? Let's consider that a trader buys the 15th of August 270 call, or how much does that cost us? Between 23.15, 23.45, let's call it 23.30. Now, what is that real cost there? $23.30, but these are standard contracts. We have to multiply that by 100. That is a $2,330 trade, a $2,330 risk. For some traders, they might prefer to reduce that risk, reduce that initial investment if possible. And that's one of the potential advantages of a vertical spread. It can reduce the initial, it can just reduce the theoretical cost and risk of a trade. And here's how it does that. Well, at the same time that we buy this 15th of August 270 call, let's buy, for our example, the 15th of August 280 call, not buy, sell. 15th of August 280 call, and that might bring in a premium. How much of a premium might we be bringing in here? 1630 versus 1650. Let's call it 1640. So if we are spending 2330 but receiving 1640, net, this trader might actually only be out of pocket about $7, a little bit less than that. 2330 minus 1640 gives us a net cost. Now, let's put that back in place. There we go. Our net cost here, also known as our theoretical maximum loss on this trade, now $6.90. That is actually a massive reduction in risk. We've essentially cut that by 2/3. Pretty close, not exactly, but pretty close. So for a trader who maybe has a smaller portfolio, or otherwise they just don't want to commit to such a large investment, obviously is in the eyes of the beholder, that's a potential advantage. What's another potential pro? Well, there's actually a higher probability of success in essentially almost all scenarios with vertical spreads versus a long call. Long calls inherently, every single one of them, I don't like to talk about absolutes, but I have not yet encountered a long call when purchased, or a long put for that matter, that comes with a higher probability of success than failure. Just doesn't happen. A couple of things working against long option ownership. Number one is the spread between the bid price and the ask price means that the trader is always starting off a little bit in the hole. That's also going to be the case of our vertical spread here. So vertical spread's not offsetting that. But time decay is also the enemy. It is the universal enemy of all of our strikes. Do you see that? Our theta is our exposure to time decay. It's a negative number for all of those options. And if we go over to the puts, we look at that theta, it's the universal enemy of all of those. When it says 0, don't mistake that for actually 0. What that means is it's less than 0.005, but it's still there. So you'll see some rounding that might take that down to 0. Yeah, time decay is always working against that, creating low inherent probability on a long call. Actually, a vertical spread can carry from day one a higher probability of success than failure on the trade. And in any event, depending on the strike selection, when compared to the same long call, it probably at least still has a higher probability of success than failure. So higher probability of success. So as an example, if we were to just buy this 270 long call, well, it has 20 cents of theta chipping away at it in that first day. We need to overcome that in some way, either by getting price direction correct or by having volatility change enough to compensate for that. But that's upside down on us. By comparison, if we buy the 270, but then sell the 280, that positive theta actually puts the probabilities of the trade in our favor. The stock doesn't actually need to do anything, and then we could still be in our position for maximum theoretical gain there. So higher probability of success, lower cost. This is really starting to sound like a strong argument, isn't it? Well, there are going to be arguments to be made for just a long call as well. Number 3, this is highly, and I like to think that I have a pretty strong command of the English language. I had to look this word up to make sure that I wasn't using it incorrectly. This is a highly tailorable strategy. What do I mean by that? Well, for those of you who have been attending my webcast series for any period of time, we know that a vertical spread can be structured very closely to the preferences of the individual trader. Some traders prefer, or they maybe consider themselves more conservative. They're willing to go for lower potential reward with a high probability of success. That might be their preference. Well, they can do that with these long call verticals by going deeper in the money. Now, other traders may have a preference. They may have maybe more confidence in their analysis or whatever, but their preference might be to pursue higher reward, and they're willing to take larger risk of being wrong. So lower probability of success. That can be accomplished by going further out of the money. We can also change the spread widths to increase or decrease the net cost of the trade. Kelly says it's very adaptable. Yeah. Yeah. The potential for reward, the potential for risk, the break-even points, the probability of success or failure, all of those can be determined with a high degree of precision using a vertical spread. Whereas our long call traders, well, each long call has something inherent to it, and that is it has unlimited upside potential. But it also, we can't really draw a line in the sand and say, well, here is the most we can make. We can draw a line in the sand and say, here's the most we can lose where our break-even points are. So it's somewhat customizable, but not to the degree that a vertical spread is. So highly tailorable. Okay, number 4 is vertical spreads have a greater tolerance for timing issues. How many of you have had a trade before and you got into it on a Tuesday and you notice, oh, if I had just waited until Friday, I could have turned this loser around. Didn't work out. Or maybe started the trade, it got off to a good start, but the exit timing wasn't optimized. And maybe some profits, some unrealized gains were surrendered. Yep. With vertical spreads, there can be a greater tolerance for that sort of a timing issue. Just to use ours as an example, if we were to enter into this 270, 280 vertical spread, let's put that on our chart. I'm going to right click on these drawings. Let's clear the drawing set. And I'm going to draw in some lines here at 280. 280 is right about here. And then 270 is down about here. So those just represent our strikes, okay? That's our vertical spread. Now, the trader might have a preference for price to go up and to still be above 280 as we hit expiration. But what if they're off with their timing a bit and the stock starts to come down? Well, as long as we're moving toward expiration, and especially as long as we're still above 280, that can still work itself out. Our stock might just do this. Maybe the stock decides to not even be bullish, but as long as we're still above 280, it doesn't matter. If we were, well, it potentially doesn't matter. Still, of course, we're in a short contract here, and there's risk of assignment, but in this case, assignment on the short is the objective of the trade. But in any case, yeah, we might be able to make arguments all along the way here, where what if our trader had got into a bullish trade here, but stock still went up above our strikes? Timing, turns out, didn't matter so much. It might have been some scarier moments there, some more uncomfortable moments, or maybe they got in here and the stock pulled back, still worked its way up a little bit. There can be greater tolerance for timing issues. Whereas if our timing is off with a long call, then our price is moving against us, and theta is working against us. Time decay is working against that trader. Not as much tolerance for timing issues. Number 5, we can see reduced or even reversed time decay exposure. Let me ask you the question. How many of you have heard that when you buy options, the time works against those trades? That's true when we're just buying long options. Not universally true when doing vertical spreads. So with our spread, we already saw if we were to buy the 270 call, right now it has a theta of about 20 cents, minus 20 cents. So that has negative time decay exposure. But the 280, we're selling. Selling, time decay, typically assists those traders. That has positive time decay of 22 cents. I don't know about your math, but mine says if I have negative decay exposure of 20 cents, positive exposure of 22 cents, that's a +2. Time is working in the favor of this trade. Now, I'll say it does that as long as it's in the money. Going out of the money can reverse that to some extent, but notice it's still dramatically reduced net versus just long call ownership. So we can reduce if we're doing out of the money vertical spreads, or reverse if we're in the money vertical spreads time decay exposure. So we add up all those pros. That sounds like a strong case for vertical spreads. These add up to some of the reasons why some traders prefer long call verticals versus just long calls. Lower cost, higher probability, highly tailorable, greater tolerance for time decay. I don't even have to be very precise with when I get in, and time's working for rather than against this trade, depending on how I structure it. Sounds great, but there are potential cons. What are those? Well, when we do a vertical spread, buying a call, and then we throw a cap on it by selling a call, that limits the profit potential. That might not sound initially like, well, yeah, okay, that's a trade-off, but I get all these other benefits. I want to do a quick revisit of history, and this is where I hinted a little bit earlier. We might be able to see why some people might make an argument for just long call ownership versus a vertical spread. Put yourself in the shoes of maybe a trader who bought a long call for a couple of months back here. Stock's trading at 160. Within a couple of months, that's a $260 stock. There were probably some massive profits achieved by long call owners during that time frame, whereas someone that did maybe a vertical spread down here might be sitting on their $1 or $2 that they made, and they've got FOMO. Yeah, that's a real thing. When we cap the upside potential, that is a major trade-off, and that's a strong that's a strong consideration for some who choose just buying long calls over long call vertical spreads. Number two is and this is a con again of doing a long call verticals, conceptual con. They tend to be less responsive to price moves. So we might get into a trade. The stock makes a nice quick initial jump just over a couple of days. We might have been thinking, well, we're in this for a month. And a long call owner might be looking at 40, 50, 60, 70% profit. And a vertical spread trader might be looking at a 10, 15, 20% profit. Obviously, those are just numbers that I'm using as examples. But yeah, less responsive to quick, shorter term moves. Number three, they are more complex. Some of you are still looking at all of this and saying, oh, my head hurts thinking about trying to buy a call and sell a put. How do those two things work together to produce a profit? Where are my risks? Where's my risk exposure? What if I start to tinker with things and I get out of one or the other? This gets complicated fairly quickly. Yeah, it requires probably a longer learning curve, more practice, more repetition. Yeah. Now, finally, there are more fees. When we do one contract versus two, one leg versus two. With one leg, there are fewer fees, and with two legs, there are more fees. Now, not as enormous a consideration as maybe it once was, but fees still exist, and we need to be aware of those. So traders might look at these among other potential considerations. I might not have made an exhaustive list here, but for some, they'll conclude, I want that unlimited upside potential on my long calls. I want that very large profit potential on my long puts. I don't want to hinder that by selling a short call again or a short option against that. Others may prefer the lower cost, the higher probability, the tailorability, all of that. But guys, we're going to go ahead and place our trade here today, and we are going to go with the vertical spread. So let's do, because this isn't called long diagonals and long options. It's called long diagonals and vertical spreads. Long diagonals and verticals. Anyway, long verticals and diagonals. Can't even get my series title right. Anyway, let's buy the 270, sell the 280. That's our example. Could have tailored it to some other combination of strikes. That's one of the points that we made here. But I'm going to do this way. Let's go up here where it says spread single. Let's change that to vertical. That just pairs up all the different strikes with the next one. And then we can click on the ask price to create our long call vertical. And it looks like at the moment, we were looking at maybe spending $6.90. It's still in about that range. Let's say that we're willing to spend $7 into this. That's going to leave us $3 for potential profit if we're able to fill. $700 of risk per contract means that if our trader has a certain risk threshold, let's say that our trader, let's keep it, we've been trying to keep it under $4,000. So that might be around, not 10, that would be 7,000. Half of that would be 3,500. Should we push it up to 4,200, maybe do 6 contracts? Let's do that. Let's click confirm and send. Buying these 6 verticals, or trying to get a $7 limit. We'll see if we can get fill for that. That would have a total cost of $4,200 plus $7.80 of commissions. That would be our maximum theoretical loss. Our maximum theoretical gain would be about $1,800 if we're able to stay above 280. If we're ultimately able to achieve exercise and assignment, that's where we'd like to be. And let's send that order off. See if we can get that filled. Let's look at our working order here. $7. All right, we're offering a $7 debit. It's sitting there at $6.85. There it is, filled at $6.90. Okay, cool. So from here, what preference do we have? Well, we'd like our stock to stay above 280 and hit that August 15th expiration. If it falls below 270, that's our max loss territory. So this is where we don't want to go. Let's make that pink. And let's scrunch that down. This is where we'd prefer to be. And you can see we're already there. That's the reason why this is already a higher probability trade straight out of the gates. Doesn't mean that it's going to turn out that way. But that'll do us, guys. So we'll follow up on this in future webcasts. We'll talk about the management of this trade and other trades, the pros and the cons of management decisions along the way. But as for now, we've accomplished what I wanted to do today. I wanted to outline the arguments for a vertical spread versus a long call, but also the arguments for a long call versus a vertical spread, because there is no right or wrong answer when it comes to options trading. There's no one size fits all. So I want that to come through in the messaging here. This is always an education for weighing the pros and the cons of different strategies and making the decision if options are going to play a role in a trader's portfolio at all. Making the decision for which option strategy is most appropriate for that trader. All right, everybody. Thanks. I will see you again for this webcast series next Thursday. But before you go, just remember that you have some resources available to you outside of this, outside of the live streams. So number one, make sure that you have subscribed to our Trader Talks channel. So you can go down right down the lower right-hand corner, click on the subscribe button. It literally only takes a second, doesn't cost anything. But our Trader Talks channel is where we house our previous webcasts. So you don't just have to watch everything live. We also have archives right here under playlists. You can join the live streams right here as well. And you can do searches if you have a keen interest in learning something. Maybe you want to learn about charting. You can do a search for that. Anyway, for example, my playlists here, for playlists, I'm going to click on the playlist, go most of the way down. This webcast series happens to be down 3 from the bottom. There's long verticals and diagonals. You can see my full playlist right there. Last week, we talked about a guide to trading vertical spreads in earnings season. I think that was good discussion. Another thing that I would suggest everybody do is if you have an account on X, you should be following your favorite presenters there. And you can find me on X at Cameron May CS. That's my handle. Make sure that you're precise with the way you spell it. But this is where I come to connect with my audience members in between the live streams. You know, when somebody replies to one of my posts, I'd go in there and I try to reply right back to them. I've been on there, probably replied to about 20 posts just in the last 24 hours. Not 20 posts, but 20 replies to my post. Anyway, thank you also for everybody that's already clicked the thumbs up. If you watch one of our webcasts and you appreciate it, make sure you show your appreciation by clicking that thumbs up. It's not just a pat on the back to the presenter, because it is that, and it sounds like applause to me when you do that, but it also gives a boost to our webcasts in the YouTube algorithm and helps us find a wider audience so people can learn these sorts of like comparative analysis of two different strategies like we've done today. So if you enjoy webcasts, make sure that you click that thumbs up. And one more thing for me to just quickly check here in the chats, just to make sure I didn't miss it. Yep, doesn't look like there was a survey. But thanks, Scott, for helping out. Definitely appreciate it. Everybody, I will see you tomorrow for tomorrow's webcast. I'll see you next Thursday for this series again. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.